All right, everybody, welcome to the show, the Winning Momentum Podcast. I'm your host, Scott Sinclair. We are episode 228 today. I own a company in Canada and in the U.S. by the name of Sinclair Range, and Sinclair Range in turn invests. Part of what we do is we invest and advise into troubled businesses, and so we own different businesses. And we have a bunch of, so the businesses that we own, our portfolio would be in tier 1, tier 2, automotive manufacturing, hardware manufacturing, two different companies, financial services. We run a hemp processing facility in the U.S. And so we have a diverse range of portfolio assets, and we're always looking to acquire more. And we have a number of client files. And clients these days are looking for money. That's why companies are coming to Sinclair Range in this particular economy. And we're dealing with several fundraising challenges across various client files in various sectors, including right now mining, energy, cannabis, manufacturing, financial services, you name it. Companies are coming to us looking for help to recapitalize, finance their business, and get them out of the difficulty that they're in right now. And those financing requirements, by the way, would range from anything from small bridge loans, we're trying to get from here to there on a transaction or a turnaround or a going public transaction, to large acquisition needs. So these are the things that we're working on at Sinclair Range right now. By the way, you can look at sinclairrange.com and reach out to us if you want to talk about that, or just hit me up in the comments section of whatever you're listening to the Winning Momentum Podcast, whatever platform you're listening to this on. So every day, what we're learning in this economy is that the universe of possibilities to finance your business is very much narrowing. Opportunities are going away. There's a lot of uncertainty in the market. Lenders have stopped lending. Equity markets from certainly on a retail side dried up in lots of sectors. Some sectors are still hot, but have dried up. And so it's a difficult market. Do you watch Kevin O'Leary at all? Do you ever see him on CNBC or on social media clips? On his Instagram is pretty good. Mr. Wonderful of Shark Tank fame, who I always think of as being a Canadian. And I believe that he is a Canadian by passport, although I think he has 7 passports around the world. But I always think of him as being as Canadian because I used to run into him at steakhouses and bars in Toronto back in the day, downtown on Bay Street. But anyways, Mr. Wonderful of Shark Tank fame, and he is a pundit now. You see him on the financial shows, and every time you see him, what is he preaching right now? He's preaching that the capital available for medium and small businesses is completely dried up. There's nothing available. His arguments or his analysis of the situation is that lending rates are way up, which they are. U.S. prime, last time I checked, was 8.5%, whereas it was 3.25% pre-Biden. And for those of you not experienced in financial metrics, prime is, sort of the risk-free lending rate on which you base everything out else. Let's put it that way. So if you're borrowing, so before Biden it was 3.25%. Now it's 8.5%. That's a pretty big jump. And if you're borrowing at, say, 3 above prime, right? So it used to be 3.25% prime, and you're borrowing at you're a customer of a bank who's borrowing at 3 over prime, well, then 3.25 plus 3 is 6.25% interest rate. Okay? That could be one way that this works. It does work that way for many, many companies, but there's other ways that it might work as well. But for this example, so you're at 6.25%. Now the rates have gone up to 8.5% plus 3% above prime is 11.25%. So you've gone from 6.25 to an 11.25%. Not quite double, but almost double your interest rates. So the lending rates have gone way up, which causes a lot more risk. We'll talk about that more later. Kevin O'Leary, Mr. Wonderful, also says mortgage rates are up. A 30-year Mortgage rate in the U.S. is roughly 7.25%. I believe used to be 3% pre-Biden. Okay, so your mortgage payments, your interest component of your mortgage payment on a 30-year AM is a lot of interest, has more than doubled. And so that puts a lot of pressure on mortgages, defaults on loans. Companies can't afford to pay. Companies are struggling to pay their leases as it is. And so landlords, property owners are under a lot of stress. So regional banks, he says, don't know what their equity needs are going to be now or in the future, really, because they don't know the quality of their assets, of their book. The banks are under pressure because of the bank failures. When was that? In the spring? Silicon Valley Bank, I believe, and one or two other regional banks that had to be bailed out by the governments. And so the regulators are descending on these smaller regional banks to review them for safety. And meanwhile, so they don't know so they're under pressure from the regulators. Meanwhile, their assets, the assets of these banks, which are loans. So when you borrow money from a bank, now you have a liability because you owe the bank money. But the bank has an asset. It has, a loan that it can collect with interest and fees from you, and that's what banks do for a living in part. And so their assets are 40% in commercial real estate. Again, this is Kevin O'Leary's analysis of the situation. So 40% in commercial real estate. By the way, that market's about a $1.2 trillion market in the U.S. It's a massive market, but 40% in commercial real estate, and the debt service on that commercial real estate has doubled because the interest rate has doubled. And even if there is a fixed rate, the terms will be expiring soon because commercial paper is generally short term. So the amortization could be 30 years, but the term could be 3 years, 5 years, whatever. And so it expires, which means you need to refinance, which means you're going to refinance at the new rate, which is going to move your loan from, say, according to Kevin Leary, in the 5 to 6% up into the range of 10, 11%. So again, your payments are going to double. At the same time, tenants are struggling because downtowns are not fully back to work. And so all of this is causing the banks, the smaller regional banks, significant pressure. And it's going to cause, according to Kevin O'Leary, or already has started to cause, a run on the banks, where if you're a large depositor, if you have your payroll account for a good mid-sized manufacturing firm with a lot of labor, and you have your payroll account, well, you're moving it out of your local bank and you're moving it to the larger banks, the Chases, Bank of America, et cetera, because you know that they're safe, and you can't risk even like the 4 weeks of shutdown if in the event that there's a problem with your local bank before the government steps in to bail you out. In fact, you can't even count on the government bailing you out, although that has been their track record. So what are the smaller regional banks doing about this? They're, as he says, shutting the books. There's no more lending going on. They're not putting more assets on the book. They're staying as liquid as they can to meet their potential equity needs so they don't get shut down in the future. All right, so that is a problem for small businesses. And he says, so for small businesses, and by that he means less than $500 million in revenue. That's a pretty big business in my opinion. But if you're less than $500 million in sales, no one is lending to you. That is the message of Kevin O'Leary, okay? And he does say that, therefore, the factoring market is very active, as he calls it, shadow banking. And basically what you're doing in factoring is it's sort of like borrowing, but you're not technically borrowing. What you're doing is you have a receivable from whomever. Say you sell some product like we would to Home Depot, and now Home Depot owes us some money, and we can sell that receivable to a factoring company, and we can get an advance of 85% on that receivable, which is sort of like borrowing on that receivable, but it's legally a purchase and sale of that receivable. They now own it. And then when they collect it, they send us the amount that they didn't advance, the 15 or 20%, less their cut. Their cut, according to Kevin Leary, in the U.S. would be 18%. Certainly in my experience, it's way more than that. Could be annualized rates of in the high 20s, high 30s range. It's an expensive way, often, not always, I guess, but expensive way to go about financing. Also, that's taking off to fill the gap for small business financing needs, but that's just on receivables. There's also the private debt space, family offices, hedge funds. Private debt is booming in the US, booming in Canada as well. But the bottom line is Kevin O'Leary is calling for real chaos in the fall, right now, in September, October, November, right now, in the economy, for small businesses, for bankruptcies, because they can't refinance, and the cost of debt is far too high for them to afford that. And he says there's no help coming. There's no help coming from Congress. Like, all of these massive spending bills, huge trillions and trillions of dollars of spending bills, are all geared towards the Fortune 500 companies. There's zero for the small guys, yet the small guys drive the economy. So that's the analysis of Mr. Wonderful, which I believe is dead on, and it's certainly consistent with what we are seeing in our business, in our practice, helping clients even in our own portfolio. So what does this mean to you? You know, these rates go from 6%. If your borrowing rate goes from, say, 6% to 11%, which it has, what does that mean to your business? So let's just walk through that mathematically. So say your rates went from 6% to 11% in a hypothetical example. Let's say you're running at about a 1.5 times debt service ratio. What is a debt service ratio? Well, you look at, for the year, the free cash that you made, and you divide that by how much of that free cash you have to allocate to servicing your debt, which would be principal and interest payments, okay? And so they might tell you, if you look it up on the internet, that a great debt service ratio is 2 times. So you have twice as amount of free cash before you pay your debt as you do debt service requirements. If you had $100 of free cash flow pre-debt service, you would want your debt service to be a total of $50, because that's a 2-to-1 debt service ratio. Understand? But 2 is really conservative. Let's say ours in this hypothetical example is 1.5. Many loan covenants that you see when you borrow new money would be at around a 1.25. Debt service ratio would be a covenant, which is a promise in the legal agreement that we will keep our debt service ratio at this minimum level. So in our example, where we are using 1.5, and let's say, I don't know, round numbers, we've got $1 million of free cash flow pre-debt service. So a 1.5 means we're servicing $650,000 of debt. Now, if that debt service, the $650,000, is, in the extreme example, all interest, and you would say to yourself, well, that's not practical, but it is. A lot of operating facilities for companies never have any principal service at all. Obviously, term loans do on machinery, mortgages do on real estate. But if you have a revolving operating line on receivables and inventory, there is no principal repayment on that. If you have an asset-based loan, which is quite typical, I mean, almost everything that I deal with is asset-based loans these days, well, the debt service on that is 100% interest. So I'm paying $650,000 in this example in completely interest. Well, if my rates go from 6 to 11, my interest goes from $650,000 to roughly $1.2 million. Now my debt service is $1.2 million, except I only had $1 million of free cash before I have to service my debt. I used to have $1 million of free cash to pay $650,000 of debt, and I had $350,000 left over. Is that right? Yeah, that's good math. $350,000 left over, which I could, use to bonus out or dividend out to myself as an owner manager of this small business, or I could retain earnings and build up my equity and capital for a rainy day. And I sure hope I did that, because now that my interest has doubled or almost doubled, and I'm paying $1.2 million out of my $1 million, well, obviously I have a shortfall. I am losing money. I have negative net income. I have negative cash flow, and I have broken my loan covenants in my loan agreements with the bank. Remember, this is a promise to the bank that I'm going to have a debt service ratio of whatever. Okay. And so now what's my bank going to think? My bank's going to think, well, we're not happy with the economy right now. We are worried about borrowers and their interest rates. We're worried about our own equity. People always think when the bank goes after them, it's all about the borrower and the bank, taking a personal attack on the owner manager in the business that has borrowed money. But often it's because of things that, you just don't ever get to see, like the bank worried about its exposure to this particular industry, or its exposure to this type of asset and this type of loan, or its own equity needs, right? It really just needs, the bank also needs to hunker down, and you may be caught up in that cycle. So for example, right now, every one of the loans that I'm dealing with is under review by its commercial bank, not because of anything the company did, but because the bank is hunkering down and just reviewing everything in this environment. This is going on, okay? And so that is the consequence, in case, you can hear, oh, well, interest rates have doubled or more than doubled. And you think, oh, that's bad. That's a hardship on people trying to pay their mortgage or whatever. But has real practical consequences for small and medium-sized businesses in particular that don't have sufficient equity to survive these storms. And you know what? If you're running one of these businesses, if you're managing one of these businesses, what can you do? Because hunkering down until this is over and we just assume, everything's going to go back to normal, that's not the answer, because this is not going to end anytime soon. It is not going to end anytime soon. Rates are not coming down to a more manageable level to what they used to be. They were artificially low forever. The rates will not be coming down. Rates, the increase in rates has been tied to inflation. The whole point of the Feds, depending what country you're in, but of whoever raises the rates, the central banks, of them increasing interest rates, the whole point of that is to tank the economy. They wouldn't say that, but cool things off. Economy's overheated, whatever little buzzwords, nice terms they have for that. But the point is to tank the economy to lessen demand. So as a consumer, as a business, you can't afford to buy as much stuff because you're broke. And if you can't afford to buy as much stuff, now that shifts the supply-demand balance, because inflation is really caused by a imbalance of supply and demand, where there's more demand than supply, raises prices. Okay, well, the opposite is also true. If there's no demand, prices ultimately work their way through the system and they start to drop. That's why we're raising interest rates. The economists will give you a much more complicated answer than that. But to put it simply, that's the way to think about inflation. It has to do with supply and demand. And if there's a bunch of free money on the street, if the government programs are massive, if there's lots of borrowing and credit available on credit cards and bank loans and all that sort of stuff, you're probably going to go out and buy that new TV or that new iPhone. But if you can't pay your rent, if you can't pay your mortgage, if you're in trouble financially because everything costs way more for inflation, right? You can't afford to fill up your car anymore, your food bills have doubled or whatever the case may be. Well, you're not going to go out and buy that TV. You have reduced demand by raising interest rates so that you can tackle inflation. All right. But that's not going to work very well in this particular time, because inflation is a function of policy. And policy isn't going to change until the government changes. What do I mean, a function of policy? Well, a large part of what drove this particular inflation cycle has been like huge government programs, particularly out of the Biden administration, huge government programs spreading trillions of dollars of cheap money to the top of the system, to the rich, to the powerful, to the big companies. That's who gets that money. It's not you on Main Street running your corner store. It's not my local vendors here in British Columbia. They're not getting that money from the Trudeau government, and the U.S. equivalent's not getting it from the Biden government. It goes to the big boys. And the big boys use that to speculate on investments. And so that just drives up the price of anything. And another policy that caused this is the hammering of the energy industry. Okay, and I'm not here to argue whether you think that's a good thing or a bad thing. I personally think it's a bad thing, but it's a fact. If you restrict the supply of fossil fuel energy and people are buying fossil fuel energy, the demand hasn't changed, it's probably gone up, then the pricing of energy is going to go up. And that's exactly what's happened. And until the government reverses some of these policies, inflation is going to stay high. I mean, it's been really big under the Biden administration. Like some things have, doubled in price in the short time that he has been president. And so that's not going to change until the government changes, because they have to change the policy. And so hunkering down as a business and maybe in 6 months rates go back to normal and my $1 billion will once again pay my $650,000 of debt service and I'll be profitable. That's not going to happen. You cannot count on that happening. So what can you do? What can you do in this situation? Well, you really, broadly speaking, only have two choices. Choice number one, and this applies to individuals and families as much as it applies to small and medium-sized businesses, by the way. You can reduce your debt or you can increase your cash flow. That's the only choices you have. Reduce your debt service requirement or increase your cash flow. Well, how might you go about that? How do you reduce debt? If you're running a business and your debt service is causing you problems, which it probably is for everybody, if you're having squeezed margins, operating margins, cash flow margins as a result, you need to take a hard look at every possible strategy to reduce your debt. Sell something that is marginal and that you don't need for your business. It's great to have that extra piece of real estate when times are good, money was effectively free, you're profitable, you're spitting out free cash, you have that extra piece of real estate you've been hanging on to, you've got a great capital gain on it. Well, that's a good thing. This might be the time to sell that piece of real estate if you can get a good price for it and use all of the proceeds to pay down existing debt. Okay, that's one way to reduce debt. Consider a sale leaseback on real estate or expensive pieces of equipment, of manufacturing equipment. A sale leaseback means you find a financing partner where you sell, let's say it's your operating facility, you sell your facility, you take that money to pay down debt, and then you lease back. And obviously you want to make sure that the inherent interest rate within the lease is in fact a benefit to you, so that it's less than the interest rate on the debt you're paying down. That makes sense, right? So you don't want to swap out for a higher interest rate inherent in a lease, which often can be the case. Okay, but you want to lower your debt service and reduce your debt here. That's the goal. So you always need to look at the idea of a sale leaseback. Don't buy more stuff with debt, right? If you're an individual, stop buying stuff on your credit cards and instead start paying down your credit cards. That's the best individual investment you can possibly make. You have a guaranteed return of a really, really high percentage by just stop paying interest on your credit cards by carrying too much debt. Same with a business. Just stop buying things, hunker down, and prioritize the things that you need to buy. Another way to reduce your debt would be to raise equity, right? Companies often have maybe owner managers and small businesses don't think this way, but you have a debt to equity ratio. You have I don't know, let's make up a number. Let's call it 4-1. So if you have $1 million of working capital, 3-1 in my example, you have $1 million of capitalization, let's put it that way. Well, a 3-1 debt to equity ratio would mean that you'd have $750,000 of debt and you would have $250,000 of equity. So your debt is 3 and your equity is 1, right, for 4 parts. And if you raise more equity in that scenario and reduce your debt to equity ratio to 2-1 or 1-1, well, you've reduced your debt. Now, when you raise more equity, you are diluting your ownership, right? Diluting means you own less. I used to own 100% of my business. I had to raise more equity. Now I own only 60% of my business because I took on a partner in exchange for cash to reduce my debt. Maybe that's a good idea for you. Maybe it's a bad idea for you, but that is an option. By the way, I shot as a guest a debate that should be released. I don't recall the name of the podcast off the top of my head, but I'll get that information for you when they start to promote it. I think this podcast will be released in October, and it was a battle debate between someone who took on the side of debt and me who took on the side of equity, because it was allocated to me. By the way, I would always be more comfortable in the debt space. But anyways, that'll be coming out soon. And it talks about the pros and cons and the risks of taking on equity. And so that would certainly be applicable to this particular point. But fact of the matter is, we're brainstorming here. What are the ways to reduce your debt? Clearly, equity is a way to reduce your debt. You can sell your business in a more dramatic case. If you really are worried about your debt, you've been thinking about exiting your business, maybe this is a good time to do that. You can sell your business if you have value to someone bigger and better with a stronger balance sheet. This might be a way to just mitigate that risk, take your chips off the table as an entrepreneur, and it's always worth thinking about. Okay, so those are ways to reduce your debt, sell something that's marginal, consider sale leasebacks, don't buy more stuff with debt, raise equity, or just sell the business entirely. Your second option to deal with this is to increase cash flow, right? And I don't mean these are mutually exclusive. You need to look at both. But how might we increase cash flow? Remember, we had $1 million in our hypothetical example to service $650,000 of debt service. And now our debt service has gone to $1.2 million. We don't have enough money. What if we were able to increase our cash flow so that we do have enough money? Okay, so that would be another way to think about that. How do you increase your cash flow? Well, in any crisis, I've done shows on this before in our predecessor podcast called Martinis with Scott. We talked about how to manage through a crisis. And the important part here is to know exactly what your priorities are and to hyper-focus on those, to cut every single program that's not mission critical and that is cash negative. Get rid of everything that is redundant, that is nice to have, right? This is the cutting off a limb to save a life, right? An amputation. That's what's needed here sometimes to increase cash flow. And, similar to that is just in general, cut. When you're doing a budget, although I've always told you to be against budgets, but when you're doing a budget, when you are reviewing plans for the year, when you're reviewing compensation, when you're reviewing everything that you're doing, you need to do that with a cut mindset, not a growth mindset, right? Because people always think companies, I've been doing turnarounds and bankruptcy related stuff for over 30 years, I'm ashamed to say, but companies don't go out of business and run out of cash necessarily because they lose money. Sometimes it's because of really, really rapid growth, and the working capital cycle associated with that growth is negative. In other words, every extra unit of sales costs you so much dollars in working capital. that if you're profitable, you will get that back 3 months later, 4 months later, whenever it is, but it costs you money, right? So if you have to pay your supplier up front, right, because you're building something in a foreign country, so you're building it in Asia, now you got to send the money up front to get a hold of this supply chain product, and then you sell it and you have a receivable for 60 days. Well, that's a negative 60-day working capital cycle. So the more you grow, the worse it gets. And you just see that all the time. So you just need to increase your cash flow. You need to understand your cycles. You need to understand your budgeting, and you need to go at it with a view of cut in this type of economic environment. Increase your margins. I always talk about making more money is always a function of 3 or 4 key success factors, key metrics, KPIs. That's the word I'm looking for, key performance indicators that drive things. And if you're in, any business that you're in, it's always direct materials and direct labor. Those are some of the big ones. If I'm buying a widget and then I'm reselling a widget, there's a percentage gain, one would hope, a direct material percentage gain on that resale. And so you need better margins because your business profitability is hypersensitive to the big margins. And to get better margins, you need to either raise prices or you need to lower your costs, which means negotiating with your supply chain. It means being more efficient. So you need to look at that. You need to look at price increases across the board, and you need to look at being more efficient and lowering your cost of your labor, of your direct materials, of your freight, all these things that are variable to whatever it is that you're doing in your business. Change your working capital cycle. Collect quicker, pay later. Already touched on that a minute ago, but these are ways to increase your cash flow. So you focus on your priorities, cut programs that are not required, cut throughout the budget, increase your margins, direct materials, direct labor margins in particular. Collect quicker, pay later. These are all ways that maybe you can increase your cash flow to help in servicing your debt. And one of the important things about a recession in an economy, whether we want to call it a recession or not, one of the things about a crash in an economy is it forces good managers to do these things, to reduce their debt, to increase their cash flow, to be more focused, to cut the fat, because that's the type of cycle that we are in right now. And every company needs to do that. And when times are good, companies get lazy, they get fat, they do different things. This is not the time for that. Now, what if you do need to refinance your business? What if the bank wants out, you're losing money, the debt service ratio is offside. Banks are reviewing all their loans. As I said earlier, they're worried about their own equity. Your banker comes to you and says, hey, we're putting you into special loans. We're putting you into special accounts. That always means we want our money back as soon as we can. We want as much money as soon as we can so that we're liquid to deal with our equity problems. I did on the earlier episodes of our predecessor podcast that you can find largely on YouTube on the Winning Momentum podcast, or you could search on YouTube Martinis with Scott, which was the name of the predecessor show. We did 10 tips on how to refinance or finance a business in desperate need of capital. Okay. And when I say in desperate need of capital, you're going to run out of money. That's what we call trouble on this show. You're going to miss payroll. You've only got 3 months of working capital left in the bank, and you're losing every month. What do you do to deal with that? Why would any lender or equity investor invest into a situation? You can get this done if you follow these 10 tips, okay? That's what these tips are for. And I've proven that in my career over and over again. They tell me I've done over 25 billion, I think, of transaction value, most of it in my career, most of it in situations like that. It's been a lot of volume. There are products out there that want to finance and organizations that want to finance companies that are in this sort of trouble. But there has to be you have to follow these 10 rules, these 10 tips, all right? So number one is to admit to yourself, to your management team, to the world at large, to your stakeholders, admit you are in trouble. Stop deluding yourself. Admit you're in trouble. And the power of this is that you break through the confirmation bias and when you've done that, when you've totally accepted, when you've hit rock bottom and you've totally accepted that if I don't change, if I don't do something different, if I don't put everything on the table, we're done. We're going to run out of money and not make payroll. We're not going to pay our rent. So you recognize, you break through that confirmation bias and you recognize that the new money, one of the things that happens is you recognize that the new investor rules the day. I see so many pitches every day, so many pitches of companies coming to me that need cash. And they go through this whole manufactured cap structure crap, right? Well, we've allocated, $1.3 million of, Class B shares in our Series 2 round of financing, and they're going to be at this price, and they have to be at that price because that's an uptick to our Series 1 financing, and that's the cap structure that we have designed. Well, bullshit. You're out of money. You're broke. You're close to being an insolvent company. Why would I invest equity at a premium to the last guys when the last guys are the ones that have failed? Why would I do that? All right. And until you can admit that you're in trouble and the whole world has changed, you can never make the proper decisions to get this deal done. It is number one. If you want to do something, if you want different results, do different things, different actions. Different results require different actions. Different actions require different thinking. Okay, you need to admit yourself, if you're in this situation, that you're in trouble. And if you don't take action, you're going to go down, right? So I see these sorts of pitches all the time. They're tied to old ways of raising money. They're tied to an economic environment that no longer exists. And these companies never deal with the 10 tips that we're going to talk about. There's no cash flows attached. There's no hard exit strategies. There's nothing, and they are not going to raise money. They're going to fail. So tip number one, admit you are in trouble. It changes your entire mind frame. You can put everything on the table. Tip number two, identify the trouble, why it happened, and the people responsible for that trouble. Well, what does that mean? You could say, hey, it's not my fault, Scott, that the Biden administration was elected and they cranked up energy prices and they stopped the gravy train of free money because of the resultant inflation of their trillions of dollars in new spending. That's not my fault. That's some sort of global conspiracy of events that have put me in trouble. Well, no, because it's you that put yourself in the position of having too much debt at variable rates and not enough cash flow to service if something goes bad, and not enough equity to ride out these cycles of the economy. This is on you. This is on management, okay? And I used to say, in fairness, well, it's always 100% management's fault that companies are in trouble in medium and small businesses. Anybody at Sinclair Range that's worked with me will tell you I've told you that a million times. It's never some sort of global convergence of events that kill companies. And then, of course, COVID came along, and I was proven the one in a million wrong. But for the most part, let's say, it's always management's fault. And unless, number one, you can admit to yourself that you're in trouble, and number two, understand why you're in trouble, what you did wrong, and to raise money. Remember, you're trying to sell another stakeholder here on coming in and giving you money. You have to give them a reason to do that. This is what we did. This is the mistake we made. Here's how we're going to change, which is my point number three. But you need to understand that if you if you're a company and you're coming to me and you've raised a bunch of money from friends and family in the past in equity, and now you're out of money and your original plan hasn't worked, and you come to me and say, give me more money, what am I going to think to myself? I'm going to think to myself, these guys didn't succeed on their first plan. Why would they succeed this time? So you need to, in financing a troubled business, you need to create and tell a story, not a spin, a true story, a narrative. This is what happened. This is why it happened. Here's the changes that we have made, and here's why we think it's going to work this time. And this identify the trouble. You can change people. I often suggest to clients in this particular situation, make changes. Because probably you need to make changes because it's true. You have failed. You have got yourself into this position with your management team. Your management team is either not good, or it needs to be because there's individuals that need to go that didn't pull their weight, or it needs to be augmented because your management team's weak because you don't have enough people with the right skill sets. So maybe you need to fire and change. Maybe you need to hire more people, but you need to do something to understand why you got in this position and to convince an outside stakeholder that you get it. You're not just coming hat in hand and saying, hey, if I don't get some money right now, all of my old shareholders are going to lose everything. That's what's going to happen. So invest in my business. And I hear that exact pitch every single day in this economy. So tip number 2 is identify the trouble and the people responsible. And tip number 3, of course, is to make a plan to fix the problem. Show some action. How many companies know what the trouble is? They know they're in trouble, but they're paralyzed. They're frozen with fear and don't want to act on the crisis. Okay? Change the team. Do something. Convince a prospective investor that something new is going to happen. Different results require different actions. Different actions require different thinking. Point number 1 and 2 are about your thinking. Well, point number 1 is about your thinking. Point number 2 and 3 combined are about your actions. Know why the trouble occurred, identify why it happened, identify the responsible people or the failings in your team. And then point number 3 is to make the changes. Okay? Come up with a new plan, create that narrative that is supported by action. Okay? Everybody loves a good story. That will attract the right investor for your company. Prepare a written business plan is the next. I think I'm at number 4. I didn't number these on my notes, but prepare a written business plan with a month in numbers, by the way, not in words, in numbers, with a monthly rolling multi-year model. And that's the right tool. I won't go into details on what that is on this particular show. You can see it on prior content. We will do it again. But basically, you need 2 tools to communicate and to manage and to monitor when things are tough. The number 1 tool is often in a spreadsheet, is a monthly rolling 12-month 3-statement model. So a full model that blows out for 3 years, 5 years, and it's got its key assumptions tied to that. There's a certain format to do that in, and you need this done to be able to communicate your plan to a prospective lender. And the projection period needs to exceed the exit period for the investor. If I'm an investor in equity, let's say, and you want me to put $1 million of equity into your business, and you show me a plan that goes a year or 2 years without any exit, how do I get my money back? That's not in the plan, right? If you want to borrow from me or from a private lender, if you want to borrow a bridge loan for a year and you don't have a plan that shows me how I'm getting out, well, that's not a very interesting deal to me. If you want to borrow a 3-year or 4-year debt piece from a bank and you don't show them how they get out at the end of the day because your plan is too short, it's not detailed enough, it's not month by month where it shows that you service their debt, you're not going to get this deal done. So you need that tool. And your 13-week cash flow, which is the next tip, is the second tool that you need in this business. And that is a week-by-week specific cash in, cash out for 13 weeks, which is, basically 3 months. And the point of that is a more micro version of the first 3 months of the 12-month full statement rolling model that goes out for month by month for 3-5 years, right? So this is a more micro, so that you really see that you're not running out of money in the next 90 days here. This is a tool that you need to manage your cash flow, your working capital cycles, et cetera. So you're not putting in sales, for example, you're putting in collections as it's cash on cash on cash. Okay, next tip, understand your security value. What is security value? If you're getting a mortgage on your house, the bank puts a charge, right? A mortgage charge on title, and that is their security. You don't pay your mortgage, they're going to take your house. That's called security. Okay, same in a business. You can take security, floating charges or fixed charges. You can take security over receivables, over inventory, over the real estate owned by the business, over the manufacturing equipment. You can even take security over POs and other kind of intangibles sometimes, although maybe not in this economy. But you can take security over assets owned by the business, just like you can give up security to your bank for your mortgage in your personal life. And so if you don't understand what your security value is, like, are my receivables really good? Are my inventories really good? What is my manufacturing equipment worth? Not to me, but to a lender. You need to know what your security value is, because coming back to admitting you're in trouble, you need to, part of that is prioritizing, understanding that new money needs to be not used to pay out old money, to support the value of old money, but rather it needs to be protected ahead of old money, okay? Like all old money. And so that means it needs security. It needs a priority call on the assets if things go wrong to help get their money back. And so often turnaround financing or financing for a troubled business is structured as debt, which may have an equity component in terms of conversion or kickers or whatever, but it's often structured as debt specifically because it needs to have a priority position over the value of the assets of the company to protect itself. So if you don't know what your security value is as a business owner, well, you're probably not going to get your deal done. Next tip is you need to understand the universe of lenders and lending structures. A lending structure is a type of investment, like pure equity, hybrid products, pure debt, secured debt, convertible debt, bridge loans, term loans, revolving loans, right? You need to understand the market that you're going into. It does you no good to spend your time when you have limited time by definition because you're running out of money. You have limited time to go to someone or some institution who will never be interested in your type of the product that you're offering. It has nothing to do with you. It has nothing to do with your business. It has nothing to do with the industry potentially, but it has a lot to do. It has a lot to do with the fact that they just don't do that particular product, right? Maybe like a lot of private debt, for example, they get their money from somebody else, from larger institutions, pension funds, and what have you. So they get their money from somebody else and the money, or they have leverage, right? They in turn compile all these loans that they lend out money to small businesses like you, and then they go to a bank and say, hey, can I borrow on these loans? So depending on where they get their money from, they may have covenants and restrictions on what they're allowed to do with that money, the types of things that they're intending to get into. And a super simple example of that is you could have a private debt fund that in a current market is priced at, let's say, 10, 11%, which is really not very risky. That's sort of more like bank loans at this point, versus a private debt fund priced at, say, 18%, which is obviously more risky. They're a different profile. Don't take your 18% deal to the 11% lender. Like, why? If you don't understand your market, you're just going to waste your time. You ought to be focused, right? So understand your universe of lenders. How? Get an expert like us or somebody else on your team that can help you with that. Expect to pay more. Okay, this is the next tip, and it's really important for troubled situations and raising money right now. Okay, in this particular type of economy, you need to expect to pay more, and also the next tip, you need to expect to report more. I haven't seen it too much in this cycle yet, but in prior cycles in my career, I've had so many troubled companies come into me, and the worst case is they're owned by real estate people, and real estate people think of mortgages, they think of long amortizations. It's not picking on the person, but it's just their frame of reference, and they think of low rates. And I say, well, for this company, man, the only option you have is to go to a high yield secured lender, and you're going to pay 15%. I'm just making up a number, but back in the day, I've had many clients in at 18% for a period of time. It's just crazy. The rates that you have to pay sometimes, depending on the cycle of the economy and how bad your deal is, but it's better than diluting all of your equity, right? And so it's, there used to be a group in Toronto back in the day. I won't say their name because we have lots of people listening to this podcast who probably work there. But they sort of created this high yield lending product, always asset-based, loan-based. And it was always, and their pricing was 18% back then. This would have been, I don't know, 2001, 2, 3, 4, 5, somewhere in there. I don't remember exactly. Let's call it 2005 or even a little bit later. But they had so they'd lend you 18%. And clients would say to me, well, that's nuts. I can't afford to pay 18%. And I would say, you're right. You're absolutely right. You cannot pay 18% forever. However, if you're paying 8% now and your operating line is, we're going to borrow $10 million, okay, and your 8% turns into 18%, well, that's an extra 10% on $10 million. That's $1 million of extra interest. And it buys you a year to turn around your business. Otherwise, you're going to go insolvent right now. Okay. That was the way you needed to think about this product. And so would you pay $1 million fee to save your business? Because your other option is bankruptcy. Your other option is selling your business for nothing, so you get nothing out of it. Why would you not try this? Okay. Don't screw up, because if you have to pay 18% heading into year 2, then you're screwed. The bank's going to take everything, this particular lender, they're going to call on your personal guarantee. It becomes a very difficult situation. But this is an opportunity to save your business for that bridge period of time. And, with that framing, for a lot of people, that product made a lot of sense. So you expect to pay more because of the trouble that you're in, because of the cycle in the economy, and you expect to report more. You do that sort of asset-based loan, they're daily reporting, and then more massive weekly reporting. People are like, my other bank, I used to report once a month and never really looked at it. Yep. Well, these people are going to give you a bunch more money than you have now. You get more liquidity, more availability, as we would say in the asset-based loan world. You get more availability to fix the problem that you're in. You're going to pay more and you're going to report more. And the last tip is to consider other options besides financing. Strategic partners, managing your cash flow, like I talked about earlier, selling excess assets, reducing the debt, selling your business, okay? All of those things actually that we talked about before. So those are the tips to go about refinancing a troubled business. And it can be done. There's a universe of investors out there that like this sort of situation, okay? But you need to do these things to be successful at that, okay? I put this out on my LinkedIn, by the way, actually a couple of social media platforms. I said, hey, we're going to do a podcast on this topic. What do you think? And I had some good responses. One of them was creative financing. Talk about creative financing such as sale leaseback, cash flow optimization, negotiation with vendors and clients. That whole recommendation from this particular listener who I know But that particular recommendation is focused on what we talked about in terms of increasing your cash flow, right? When we talked about cut, get rid of peripheral programs, reduce your debt through sale leaseback, right? Increasing your working capital style, which is negotiating with vendors and with customers. So you're trying to increase prices and lower the purchasing costs so you have better margins. So good input there. And another one I liked was from an actual lender who does not really difficult high yield stuff, but a little bit high yield stuff. And they do it en masse in the United States. The borrower should be upfront with the financing source regarding the situation and provide all necessary information. This is not the time to spin or play games. Time is the enemy. Now, this is a direct lender in the business development side of this, and this is exactly the first parts of my tips to refinancing a business. If you spin, if you go into the lender, like I've said, I've been getting pitches nonstop that, there's no admission that there's trouble. There's no admission that this investment they want from me or they want me to go place from them is way riskier than the situation of the last investors who have lost all their money apart from new money coming in to save them. This is no time to spin and play those sorts of games. Admit that you are in trouble, identify why you're in trouble, make changes, take action, and treat the new people, the new cash with respect in that discussion. As this particular person says, you need to be upfront with the financing source regarding the situation. Okay, so those are the same points in different words from people that are experienced in this industry. I think that's all I have today. I wanted to get over the hour mark because I'm told the YouTube algorithm is better that way, but who cares? Who cares? Thank you for listening. This has been the Winning Momentum Podcast, and we will talk to you next week.